And joining us now is Jana Mercereau, who is the head of corporate M&A consulting at WTW. Jana, we have seen plenty of fear out there in the market at this stage, and that's just around day-to-day stock trading, let alone when it comes to M&A. Just give us a sense of how bad sentiment is around doing big transactions at this stage.
Thank you very much for having me this morning. So what we're seeing is this quarter that deal value is up, but deal volume remains down, especially in the absence of those mega deals, the ones over 10 billion. And that's probably because of the cautious optimism going into the busiest quarter of the year. There's plenty of dry powder, but the deals are getting harder to close, especially the cross-border complicated deals. And there's just more measured patience and really wanting to make sure that the deal logic makes sense.
Jana, when the pound collapsed the other week on the back of the mini budget, it did feel as though we might be looking at a perfect opportunity for some of those US-based funds to get more active on acquisitions here in the UK. Yet again, any signal that that's changed in recent weeks, despite a little bit of recovery in pound?
Well, M&A certainly thrives on a confident, stable market. So when there's more certainty in the economy, M&A is likely to continue, but with a more cautious tone, especially as we head into the busiest quarter of the year. So those deals that make sense, that are well priced, they will go ahead, but probably need a well-articulated strategic rationale.
Good morning to you, Jana. The fee structure for our M&A banking viewers and lawyers watching, it's a disaster at the moment, isn't it? Fees are dropping plummeting like a stone, aren't they?
That's entirely true, but there's certainly pent-up interest for M&A, and when it does pick up again, similar to 2020, it will be, back up to epic proportions.
I think, John, do you know that? Because 2020 was a very specific event surrounding COVID. I shouldn't laugh, but it's just your answer was saying it going back up to epic proportions. That's not what I'm hearing from my friends in the Square Mile and Wall Street at the moment. They're not hanging on to the spare bankers. They're getting rid of the spare bankers. But you honestly believe that this is a blip and we're going to see, epic proportions in terms of the fees?
Well, what we've seen in 2020, the second half of 2020 and 2021 was certainly a blip. That was unusual pent-up demand because of the pandemic. But what we're also seeing is that there's plenty of dry powder in the market. The PE investors need to spend that, and there's competition for well-priced assets, also fueling M&A for those tech assets as companies face digitalization. So M&A needs to happen, and there's no indication that it will go away.
Jana, let me ask you about multiples then, and how value is now calculated for the industry. Because when money was so cheap, you could value a business even if it had negative EBITDA. So it kind of made a nonsense of the old EV to EBITDA model. But it didn't matter because there were enough other reasons for you to believe in the story to want to own it, because it was a growth company and it was going to do fantastic things. Now we know it's getting much harder because companies that are in the business of buying want to actually see some earnings. So how have multiples changed? How are we rethinking the way businesses are valued?
So I think that you certainly need to buy things that are well priced. In terms of the multiple, that really depends on how badly you need that assets to, achieve your growth and your deal value. So things like the TMT industry, the core assets, healthcare, utilities, those, are being bought at more competitive price. The hot commodities, certainly transportation and logistics, we're seeing heightened demand there too.
All right. Thank you so much for being with us. Good to hear from you.